Are you ready to take control of your family legacy and financial future? Howard Kaye and his experienced team have been helping families and business owners coast to coast with their most important financial decisions for more than 60 years. They have the proven strategies you need to grow and protect your wealth and family legacy for generations to come. Whether you're focused on wealth creation strategies, planning for guaranteed lifetime income, selling an existing life insurance policy that's no longer needed or wanted, or simply leaving a financial legacy for future generations, Howard Kaye has the resources to guide you every step of the way. Howard and the team at Howard Kaye Insurance Agency LLC want you to live a rich life that's well planned and tailored to your dreams. Live Rich, Die Rich starts now.
When it comes to life insurance, a lot of thought and money goes into the purchase of it, but very little time and thought is given to the available exit strategies. What you don't know could hurt you, but today you'll learn cutting-edge financial strategies and tips on creating significant wealth while potentially eliminating a major unnecessary expense. Welcome to the program, everyone. I'm Amy Sharp. Joining me, Howard Kaye and Tony Scuderi with Howard Kaye Insurance Agency. Welcome back, guys.
Thank you. Great to be here.
Okay, you ready for this today?
Absolutely.
Lots of content to cover today. You know, many of us have life insurance, but our needs and circumstances change. So we really need to think about how we reevaluate maybe a better reapproach to this. How does that work?
Well, no question. You know, one of the things we say to our clients and prospects is to review their existing insurance policies. Like you said, many people do have life insurance. And it's all about education, because the more information that you have, the better equipped you are to make the proper decision. And what we have found that many people had bought life insurance policies years ago, and typically they throw it in a drawer, they put it into the safe, and they never look at it again. And many of them don't even look at the annual statements that come in. They just assume everything is working as it's supposed to. But that's not always how it goes, because interest rates have come down from years ago when they bought those policies, and maybe premium structures have changed. Maybe they didn't pay the way they thought they were supposed to pay. So now they come to find, after doing a review, that either they have to increase their premiums in order to get a longer duration on their policy, or they have to accept that reduced duration that the policy will last. In some instances, people might even look to reduce the death benefit so that they don't have to pay more premium. So what we like to do is go through a thorough policy review, see what options exist. Now, typically the first one might be to see what that cash surrender value is in their existing policy, and if we were to take that and move it to a new insurance company, can we buy the same amount of death benefit for, let's say, the same premium, but with a longer duration like they originally had anticipated? Or can we give them exactly what they have, but for a much lower premium? So those are first steps in reviewing a policy. The next is to analyze whether somebody really needs a policy, and is there a reason to look at the life settlement marketplace? As an example, I can tell you some years ago, I had a gentleman who was 69 years old. He was a physician, a radiologist, and he had very expensive equipment in his practice, and it was all financed. So he wanted to make sure he had the proper amount of money in insurance, God forbid he passed away, to pay off those loans, so it wasn't a burden to the practice or to his wife. We bought a $5 million policy on him at the age of 69. It was structured to only go to age 90. We've talked about this in previous segments with life expectancy insurance. By doing this, he was able to spend $75,000 a year. Now, why do I say he was able to spend? Because I took him out of his last policy prior to that, where he was spending $112,000 a year, and he had $650,000 of cash. So what was the end result? He was able to put $650,000 of cash in his pocket and have $5 million of insurance, the same $5 million, and only spend $75,000 a year. So that was a win-win. Fast forward 9 years later, he's had some severe health problems, but we went to the life settlement market to see what its value is worth. And after negotiating back and forth, we found that his life expectancy was somewhere around 8 years. Well, he had put in 9 years of premium of $75,000. So that's what, $675,000. we were able to secure an offer of $2.2 million for the sale of that policy. Now, I know that's not necessarily what his intention was, but he said to me, we've paid off the medical equipment. I really don't need the insurance other than my wife would like it, but I don't really want to spend the $75,000 a year or what it may go to down the road. So what is it worth today? And there was very little cash value, but he was able to sell it for $2.2 million in the life settlement industry, something he had no idea about.
It just seems so invaluable to have your guidance when people come to you and they say, here's what I've got, here's what I'd like to do, and they don't always know the options. Tony, I think about you sitting down with a client and having this discussion with them.
Sure. And what's really important from a credibility standpoint, we play a little game called Let's Call the Company. Essentially what we're talking about here is we don't just come out with figures from the top of our head. We go back to their insurance company and ask for an in-force illustration that projects how their policy will perform as it was purchased, how it is currently, and we even stress test these policies to see how they'll perform at different interest rates. So the client will have some sense of what they can expect going forward. That's part of the decision-making process as to whether or not they keep the policy, whether or not they fund it additionally so it goes to the intended duration, or in the event of a life settlement transaction, if they should decide to sell the policy, they need all that information. So we've got to get accurate information. It's not coming from a selfish standpoint or from us personally. It's coming directly from their insurance company.
All right.
But I will also say that as helpful as it is, or appreciative that the client is, by learning about these different approaches, I just can't tell you how rewarding it is for us to be able to see that I was able to help somebody who just was not educated in this area, had no idea of the thought of the idea, no one had approached them with that, and when coming to us to do a review, this is what ended up coming out of it, and it was just a win-win for everybody.
Okay, life settlements, and we've got more coming up with you guys, so don't go away. Up next, how can you tune out some of the confusion and financial noise about life settlements? And later, Howard and Tony answer your questions. That's all coming up straight ahead. Stay with us.
Everybody needs a plan. If Carol's ever going to retire, she needs a plan. So does Bob, if he ever wants to catch a break. Jim and Susan, they need a plan to keep the beat going. And Puddles over there? Yeah, he's gonna need a plan too. You? Yeah, you probably need a plan. Whoever you are, whatever you do, you can use a plan for retirement. We can help.
Welcome back, everyone. I'm Amy Sharp here once again with Howard Kaye and Tony Scuderi of Howard Kaye Insurance Agency. And I know that as we talk about your clients here in South Florida and all the information that they are getting all the time about anything related to retirement, but specifically we're talking about life settlements today. They're seeing all the TV commercials, all the information coming in. We say the word noise all the time. How do they sift through all of this noise and get past it so they really know what they need to know?
Well, there's no question that there's a lot of misinformation out there. You know, it's a very lucrative business for the life settlement producer as far as the types of commissions. And thankfully, things are completely transparent. And we share with our clients exactly what we're looking to make on a policy. And it's really dependent upon somewhat of what kind of offers we're able to receive. But aside from that, it's that there's some hand-holding that needs to go along. There's really knowing the marketplace, because somebody can approach you and say, oh yeah, we go to all the funders. Well, what does that mean, all the funders? And who are the funders? In other words, I'm not looking for an individual to own my policy. I want institutional funds, large billion-plus funds that are buying these, that are packaging them, that all the information is redacted, that there's nothing about this individual that's going to get into the marketplace other than to that specific funder. Understanding how they go about receiving life expectancies, understanding the process of how a company is arriving at a number. And I think going through the mathematics with a client is very helpful. helpful to them in order to manage their expectations. Because let's face it, people are going to want the most they can, and then there are other people that are just desperate for money. So the first offer that someone offers, people will take that, and that's where we can come in and say, whoa, 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 this is not something you want. This is why it's worth what it is. But, you know, Tony, I'd love you to touch on this because, quite honestly, I've been doing this area of business for really from its inception, going back into the 90s. And I know this was something that was later for you. And what seems so obvious to me, but as Amy had just mentioned, the noise, I know you went through some of that with some of the different questions that would come up. What do you see as that noise out there that people are getting the wrong information or maybe misguided so that they don't understand when they should be selling or when the offer is right to accept?
Well, I think a few things. I think you got to look at the advertising. So the advertising is designed basically to do two things. One, get the client into the offices of the company doing the advertising, and two, to close a transaction. We're not transactional in that sense. Yes, we do transactions, but we're primarily about, again, as I've mentioned before, education and relationships. There have been countless examples of folks who have responded to a television ad about selling their policy, who have come to Howard, even after they've already responded to one of those TV ads, and they've come to learn that the offers they receive from those firms that are offering to sell policies are lowball offers. It's just a numbers game to them. They're looking to basically find the low-hanging fruit. Since the client didn't know anything about the life settlement business, they're more than happy to take the first offer they receive, and they're on their merry way. Howard has intervened with some of those clients to say, wait a second, you're nowhere near the end game here. There's so much more, but they've got to spend the time necessary to handle your transaction properly. The international reach we have as a firm, the relationships that Howard has with these institutional funders who know he's sincere, he's serious, and he's dependable. And when he says he's got an interested client and we need more money to close a transaction, they give him credence. And this results in higher offers to the client. So there is noise out there, but a lot of it has to do with the advertising, the confusion, and of course, just plain bad advice.
And we're almost out of time in our segment, but I have to ask this, and I think I'm kind of bringing together the pieces from what you're both saying, but the biggest misinformation or thing that we don't know about life settlements, what is it?
Good question. What is the biggest thing we don't know? I
would say this: no two cases are the same.
Okay.
No two cases are the same, but it's what the people don't understand how, even with the explanation, many times they don't understand how an offer was arrived and why isn't it more. And that's where the education comes in. And other people find that whatever that first offer was, oh, I was so desperate for that money, I need it, and they don't have the proper information. So again, it really boils down to education.
Great information as always. Thank you so much. And up next, Howard goes into some detail about the life settlement process and some of the potential outcomes. I promise you'll find this very interesting and potentially financially rewarding. Stay with us.
You have a club for every scenario, a driver for the long holes, wedges to get you over the hazards, and a putter for when you need a touch of finesse. What about your retirement? Will you have enough to play the back nine? Call to set your 15-minute phone visit today and let's find out. Get a second set of eyes on your retirement plan.
There are a lot of strategies you might be overlooking when it comes to your retirement and estate plan. One strategy to consider: life settlements. They can have a huge impact. Howard?
Thank you, Amy. Well, today on Dollars and Cents, we're going to talk about the life settlement process and some of the outcomes that may come your way. First of all, we talked about life settlements in previous shows, the history of life settlements, how they work, who's buying. But today I want to focus on really what takes place, because every day we have somebody calling saying, can I sell my insurance policy? They've seen various commercials from different companies, different funders that are looking to buy. And what we try to do is really educate the consumer to understand what's involved, what we're looking for, and how to achieve the maximum result. So it starts out very simply by obtaining all of your medical records. There's no exam that you have to take, but we need to obtain the medical records on the insured. Now, what this does is allows us to go to the various life expectancy agencies. These are agencies that the funders use to determine how long they believe somebody is going to live. And they typically start with a debit and credit system. So they may start on average for a person at age 90, and then if there is family history, they'll deduct from that. If there's been heart problems, cancer, diabetes, anything of that nature, they deduct. If none of those things exist, they may add credits to that age, bringing the months higher. So life expectancy is a key. Now, when we receive a life expectancy, everything is sent to the various funders, and many of them will do their own internal underwriting just to see if they agree with the life expectancy agencies. Now remember, when you purchased life insurance, you wanted to be in as exceptional health as possible in order to receive the lowest possible premiums. In the case of a life settlement, you want the lowest possible expectancy, not because you want to pass away earlier, simply for the funders, so that they can determine how much money they can afford to pay. Well, let's take someone recently who was 82 years old. She had a $10 million policy, and the premiums on this policy were approximately $400,000 a year. I believe the amount of money that had been paid into the policy was somewhere around $1.2 million. When we went to various funders, what they determined was if she has a 10-year life expectancy, how much money they're going to have to spend over that 10 years, what they can afford to pay you up front, and still end up with the return that they're comfortable with. Now, if I go years past, life expectancy companies or funders wanted to make 16, 17% on their money. But when interest rates were low, they knew that they weren't going to get away with pricing it at such a high rate of return for themselves. So many of the funders were pricing down at 12%, 11%, 10%. But now that interest rates are back higher again, those rates have shifted. So while the settlement industry is very vibrant and strong, they are looking for a little bit higher returns. But how does that fare for you? Well, in this one particular case, she had a 10-year life expectancy. As I said, the premiums were somewhere in the $400,000 to $450,000 a year range. They chose that they didn't want to pay that anymore, and I think, like I said, they were in for somewhere in the $1.2 million, $1.3 million range as far as what they paid into the policy. Well, when offers initially came in, of course, companies are lowballing, not necessarily on purpose. Every funder has a different box that they fit. In other words, some companies are looking for people who have life expectancies between 15 and 20 years. Some companies are looking for people that are between 6 and 10 years. There are some companies that only want to buy policies for people that have a life expectancy of 6 years or less. There are some companies that don't want to buy policies larger than $500,000, while there are other companies that will focus on $5 million, $10 million, and above size policies. So it runs the gamut, and that's why we go to so many different funders to get all the best possible offers. So in this woman's case, they started somewhere around $800,000. Now, without boring you of the details, the bottom line was at the end of the day, we were able to secure for her a $3 million bid. Why? Because after going back and forth and negotiating and seeing where one funder was being beat by another and the other funder didn't want to lose, part of the negotiation process, we were able to get that number up. Now, what was the bottom line? In their mind, they were able to take that $3 million and combined with the $400,000 and some odd thousand a year that they would have paid in premiums, thought that they could do just as well if, God willing, mom lived longer than the 10 years, they would have kept paying premiums into the insurance policy. But remember, the only payout was the same $10 million. In the case of them investing, they felt that if she did live longer, we would end up with more money. Now, if, God forbid, she passed away sooner, then the answer was maybe we didn't get the best possible deal, but we stopped the burden of us having that financial obligation when we didn't want to pay it anymore. People that have term insurance policies understand term insurance, in order to sell it, you have to be able to convert the policy. So typically we're looking for people under the age of 70 that has had some health impairment. But by converting that policy, we can often sell it, whereas when you let your term policy go, there is no cash. So the life settlement opportunity is there if it's something that fits your needs, if you're looking to get out of a policy and you want to know options other than just surrendering the policy or allowing the policy to lapse. That is the life settlement industry and opportunity, and that's all on Dollars and Cents for today.
Coming up, Howard and Tony answer some of your most pressing life settlement questions in our Q&A segment. That's straight ahead. You're watching Live Rich, Die Rich.
Our generation has always believed a hard day's work is its own reward. So for some of us, it's hard to turn off that work switch come retirement. But imagine what can happen when that work switch becomes a life switch. Then you realize every day in retirement is its own reward. We can help you flip the switch to make work days become life days.
And now we want to take some time to answer a few of your specific questions when it comes to finances and retirement. You guys ready for this?
Absolutely.
Okay, this is where we learn a lot. This is from Elaine in West Palm Beach. I'm 74 years old and far from perfect health. I have had breast cancer years ago and am diabetic. Can I sell my $1 million policy, and for how much?
Well, excellent question. There's no question that she'd be able to sell that policy. The assumption that I'd be making, of course, would have to get this information, but the assumption would be that she was in good health when she bought the insurance policy. And that's number one. So the fact that there's been a change of her health means she may have bought the policy with a preferred health category, but now maybe she's uninsurable. Well, there's an arbitrage there, you see, so that's why an institutional funder would look at this and say, this is incredible, we're buying a policy that was based on preferred health, yet she's in uninsurable health, and that's where the interest lies. Number two, we would next find out exactly what her premium structure is, and what premium does it take in order for the policy to last till maturity. And then third, get a life expectancy and determine what it would pay out. So when she says, how much do you think? It's way too early to tell, but do I believe it could be sold? Absolutely. If we were to make some assumptions, for example, and said that her premium was $30,000 a year, for argument's sake, and let's say her life expectancy was 7 years, for argument's sake, well, you can pretty much figure out that if they had to pay over the next 7 years, what could they afford to pay her? Do I think they'd pay her a few $100,000? Absolutely, somewhere in that range. But again, it all depends on all these different factors that can come into play.
Okay, good information. And here's another question from Jim in Palm Springs. My wife is 76 and I am 80 years old. We have a large $5 million survivorship policy that we purchased for the sake of our children who are grown now. We have other assets, we plan to leave them, but the premium on this policy is about to escalate to over $200,000 per year. If I can get a decent sum of money for the policy and not need to pay annual premiums, I can enhance my cash flow and create some wealth from the policy. And that might be timely for retirement. Am I on the right track?
Amy, Jim is exactly on the right track. There are a few immediate concerns it seems he has. One is that there's a premium burden that he'd be glad to have relief from. So he's not so crazy, it sounds like, about continuing to pay a heavy premium. He's got plans, it sounds like, for what he might do with that money, and that has to do with enjoying his lifestyle and his retirement. So if he could put that policy effectively in the life settlement market, retrieve some cash, And I will mention too, Howard's talked about life settlements quite a bit in this show and in prior segments, but we also don't only offer considerable payments as a lump sum to clients as cash, there's also combination offers and what we call a retained death benefit offer, where you can actually receive a death benefit that's paid up from the insurance company, and that is in lieu of receiving cash. And sometimes a client says, well, I'd like to keep the insurance for my family, but I'd like to get some cash too. Can I get a combination? And we go back to that funder and say, look, we're close to making a deal with this client, but they want to retain some death benefit. They'd also like to have some cash for their policy. Now that would satisfy his need to have some additional funds for retirement, so that would be beneficial to him. And of course, he would no longer have the full amount of insurance, but he'd have a death benefit that's meaningful, and he can work with us to determine what that right balance is, and then we'll communicate that to the various funders to establish what ultimately is the right deal for him. It's all about communication, it's all about relationship with these institutional funders, and of course, explaining the process to the client.
Most importantly, when you talk about the retained death benefit, he no longer has that obligation of premium. Even though his family is still going to receive some death benefit, that obligation has moved to the funder now.
Okay, here's another question for you from Nancy in Boca Raton. I'm 65 and in great health and own a $500,000 universal life policy. Am I a candidate for a life settlement transaction? Thanks for your insights.
Most probably not, Nancy. That's terrific. She's in great health. She's only 65, and when I say she's only 65, if she's in great health, her life expectancy has got to be somewhere in at least 25 years. When you talk about funders buying policies based on life expectancy, you know, when they say someone's expectancy is 5 years or 7 years, if they're wrong, the margin of error isn't that great. So maybe it's 8 years, maybe it's 9 years. But the longer somebody's life expectancy is from now, that means the greater margin of error. So if she really has no health issues today, she could live 25 years, she could live 30 years, she could live 35 years, and it's very difficult for these funders to price. So unfortunately, but fortunately, because she's in great health, she really wouldn't be a candidate. But if she's interested in the future to look to sell the policy, that's where we would show her how to restructure her premiums to try to put as little in as possible, so that way she would have an exit strategy down the road and be able to monetize at that time.
Okay. That's all you have to say about that, right?
That's it.
All right, that's a lot of great information. Thank you so much. And if you have a question, you can call the number on your screen or visit the website at any time. When it comes to your money and your retirement, it's important that you've considered all of your options, including life insurance, annuities, and life settlements in your retirement planning. You've heard a lot of great information today, so why wait? Take what you've learned today to help you live rich in the years to come. For Howard Kaye and Tony Scuderi and the team at Howard Kaye Insurance Agency, I'm Amy Sharp, and we look forward to seeing you right back here next time.